Hello, traders. Do you know who Deus Ex Machina is? In case you haven't seen the movie The Matrix, Deus Ex Machina is the god of the machine. And that's exactly what the market is. It's just a one big giant machine with logic. This entire up move that peaked since December of 2021, it was planned since 1995, and it went parabolic as of 2008. This whole bear market that we like to call it, and that it was in 2022, I'm going to show you where the stopping point is on that bear market, because I found the stopping point of the pandemic where that stopped at. Okay? I'm also going to show you today how the markets have already priced in that 5 trillion balance sheet increase from 2020 until 2022. That is already priced in and written off the books. I mentioned it in my last episode, but I'm going to show it in a better way, illustrate it in a better way. I'm also going to show you that markets have already priced in a recession, and I'm also going to show you what I believe the markets are currently pricing the terminal Fed interest rate to be. I'm not referring to the 5% terminal rate that the Fed's target is. I'm not talking about that. I'm going to show you calculations that demonstrate where the market is currently pricing the Fed's interest rate at, where it believes the terminal rate is going to end up at. Okay? I'm also going to share with you what level I think SPY is going to, using those same calculations. And we're going to have a short discussion on, is the Fed going to choose inflation over millions and billions of asset losses in the markets and with income to the IRS? I think the Fed is going to choose inflation. They will choose that over millions and billions of potential losses in IRS income. Keep that in mind. The Fed's not on your side, guys. And finally, we're just going to review quickly the 2008, 2022 bottom. The first time I did it, it was with the MACD. This time it's going to be with RSI. All right. So let's get into it. So, who really is Deus Ex Machina? In the market speak, they are the billionaires, the top 1%. Okay? They are the top 1%. The architect is the market maker. Neo are traders, you and I. The oracle are the channel lines, MACD, RSI, EMA, SMA, and you're going to see that clearly on the next slide. The oracle helps guide you through where the market could go. The Merovingian is the Fed. Did you guys know that in the Matrix, the Merovingian used to be the Neo of the Matrix? But the Merovingian, the Frenchman, is a part of the old world, a part of obsolete code. And that's exactly what the Fed is. They have old economic data that is backwards looking. You guys know this. They look at data that's already happened 3 months ago. They're not forward looking. So they're part of the old world. They have no idea what's going on. They didn't even get it right that it was that they kept saying, oh, inflation is transitory. You know what? You've heard that argument. You're a part of the old world that is part of obsolete code. Agent Smith, of course. The bear market. Agent Smith. Here we go. What you're looking at right here is very much part of the matrix that the billionaires, the all of the rich people, the top 1%, they have constructed this. If you think smart money is on your side, whose money do you think they used to create this monster? Smart money. Okay? I want you to think about that. Now, all of this started since the vault of 2008. All of this started. Let me zoom in for a second. Hold on. Zoom in. How do you like my Black Swan event pandemic? That's Natalie Portman from the movie Black Swan. She's a darling. Okay. Now, here's the legend. You're going to find that the main channel, here's the main channel, the big dash lines. Let me zoom back out for a second. Big dash lines, main channel. Okay? The main channel is important, full stop. Because it's where the 2019 low, it's also where the pandemic wick, it tried to stop, but and in doing so, it came back up and back tested against it, and then it shot up again. And let's not forget the hive. Okay? It's that important. The second most important is the half channel. And what the heck's the half channel? It's the smaller dash lines right here, 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 and here. It basically divides the channel in half. That's why I call it a half channel. You're going to find that major resistance lines were hit at or failed to backtest against main channels or half channels for the most part. Okay? That's why they're important. Could not backtest it against it, could not hold it. Okay? Now, so you have fourth channels and eighth channels. The fourth channels are just the half channels divided in half, right? I'm making them into quarters now, okay? And then, consequently, the eighth channels is the quarters divided in half again, right? So that's why I wanted to color code it, so it's easier to just visualize, right, as you're looking at all of this. So, once again, let me just kind of zoom in so you can get a clear picture of it, take a screenshot of it, and whatnot. But here's the June low. Went right up against the half channel. Right there. October, obviously, is the main channel. Here's the half channel. Okay? So you're going to find major pivot points. Right? It's going to try to find support. And then bounce back up, only to fail, and then, So just kind of just study this a little bit. You'll start to see the patterns. I think the next slide actually is a zoom. Oh, let me get to the next slide. It's the same view, but it's just more zoomed in. Okay, more zoomed in. There we go. Just look at it. Click pause. Kind of draw them in as you want. Major pivot points are happening at these channel lines. What you are looking at is the matrix, guys. You are looking right at it. This was in the design all along. It goes back to 2008, as you saw in that previous slide. All these lines go back to 2008. I can connect it. It's following these lines. So therefore, now you have the rules of the matrix. It's following them. Okay. Notice I didn't draw that nice trend line. You guys already know my opinion about trend lines. Totally useless. When actually it was falling, the line's going in the opposite direction all along, ever since 2008. Okay, and the reason why we're coming up on major resistance this week, big time, big time. It's not because of this. It's not because it's coming up on this trend line. This right here, I didn't even draw it in because I refused to do it. It's because it's coming up on a major EMA 50 line. Major EMA 50 on the 1/8 channel line. It's already at that juncture. Okay? That's why it's and if it can get past that, now you're up against a major channel line. That's why it's gonna be challenged this week. Not because of this trend line that started as of January, as of January 1st, 2021. That's not why. That's not why at all. This channel was already set years ago. Okay? That's what I'm talking about. You're in the matrix. You got to see the matrix for what it is. Look at that. June low. October low. Kaboom. Perfect. Now, I have a question. This is a rhetorical question for you guys. What you're looking at on your screen right here. This is mainly for the bears. I'm going to ask you a question. If a once-in-a-century pandemic that shut down the world, it shut down the world, cannot make markets fall out of this channel. It came right back in here, back-tested, and boom. If a once-in-a-century pandemic cannot make it fall out of this channel, then you tell me what will. What's going to do it? If the black swan event couldn't do it, what will? I'd love to know. There you go. There's your question. What's going to do it? Inflation? A 5% terminal rate? Come on, man. Really? There you go. There's the question. I want you to answer that question. The bears, mainly. Okay, here's another view. This is a slightly different way of drawing these lines. I'm going to zoom in. The next slide is a closer view of it. Okay. 1995, guys. 1995 went all the way up to the December 2021 top. Connecting trend lines. It all connects. The reason why this band, see, notice how I call this a bear market band, pandemic band. I'm going to get into more of that in a second. Whoa, this is a major intersection point. See that? This is a trend line, a best fit line, I'm sorry, since 2003. 2003, the low. The low. Is that a coincidence? What do you guys think? Is that a coincidence the market makers chose the low of the .com to also be the low of the bear market in 2022? No, 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 no. You think that's a coincidence? Come on, man. This is what I mean by the band. Because I put on my programmer's hat. I said, if I was being asked to program this algorithm, I'm going to ask the market makers. I'm going to say, look, if we have to crash for whatever reason, I don't care what that reason is, what's my threshold that I have to stop? Or are you going to allow me to program it so that the market goes to zero? What is the threshold that, look, I got to stop somewhere? Or are you going to allow me to stop at zero? So of course the market maker is going to say, no, you can't stop at 0. Then what is the criteria that I will stop at? And I think I found it. Anytime there was horizontal movement, that created the band. There was horizontal movement in 2020, guys. That stopped right at the top of that band. Right there. Just like in the pandemic. And you guys remember what happened on October 13th. Down 500 in pre-markets. Fiercely rallied another 1,300 in the same day. S&P 500, third largest price swing since 1967. So there you have it. It found that band. It found the bottom. It found the bottom. And I'm going to give you even more evidence that it found the bottom with math in a little bit. Okay? So, actually, similar to another slide you're going to see in a little bit, all these lines from all these different years. You know how before I'm just drawing like channel lines, like right around this area. But now this is from all different years. See that down below? Look at that. All different years. All of them are pointing towards this continuation upward channel, aren't they? Yes, they are. This has now been cut out and now been priced out. You know, this is below the channel. So basically the two extremes above and below the channel are cut out. It's now in a continuation of an uptrend. And I'm going to show you more slides of this. I'm going to show you the math behind it too. I'm just mentioning it for now. So, kind of the same thing, but more zoomed in. See, so effectively since we know this is March. Everyone knows that. March 2020. Until, what, August? Yeah, whatever. It was sideways, guys. Sideways. There's your band that it found. And it also found hidden best fit lines from previous years. Perfectly. When they join, when bands and best fit lines and those things join, oh, that's an important region, area. Okay? Now, here we go. Here's the Fred. Fred, we guys are used to seeing this already. This is the 4 trillion line right here. Since 2020, kaboom, up to 9 trillion. 8.5 trillion still remains in the system. Okay, see that? Kaboom, up. Still got all this to go, right? Look at the markets ever since that. Up, down, back to the band where you started. Here's that band, equivalent to the band. Markets touched the band, went up. At this price point right here on October 13th. SPY 348.11 to be exact. That was the day the markets confirmed all of this has now been priced in and eliminated. At SPY 348.11 on October 13th, it confirmed $5 trillion are now priced in. Okay? That's evidence. Because the price went back to the band where it started. So it's the Fed who's behind, not the markets. Okay? All right. So, now let's get into some live calculations. Okay. Now, I showed this in the previous presentation. I'm not going to redo all this, or I'm not going to rehash all that. I'm not going to be repetitive. Basically, just for you newer viewers, I'm like, yeah, but I didn't see the presentation. Okay, so we closed on Friday the 13th at 398.50. SPY on Friday, last Friday, a couple days ago. I chose September 19, 2019, right here as a hypothetical scenario that if we pretend today's date is September 19th, 2019, and we pretend that none of this has even happened yet, okay, that was the scenario. How would you price it, SPY, in the future if none of this happened and you were just on your just regular market projections in the future? Okay, that was the scenario that I projected. But I'm not going to rehash all that. I'm going to show you what I think the markets are currently pricing at. Specifically what I mean is what I think the markets are currently pricing the terminal Fed funds rate at. Okay? Now, before you keyboard commandos want to start drawing conclusions before I even started showing you anything, I'm not endorsing what I'm showing you. I'm just working out a math problem. Okay? I'm not saying I agree with it or not. I'm just showing you what I think the markets are pricing the terminal Fed rate to be. As we know, the Fed is saying, oh, it's going to be 5%. And it might even go a little bit higher than that. Or we might hold it at 5% into 2024. Okay? We all know that's what the message is. I'm just trying to tell you what I think the market is currently pricing that terminal Fed rate to be. All right? So let's go. So, as of September 19, 2019, that hypothetical day that we are pretending, the interest rate on that day was 2.04. Right? See that down lower right-hand corner here? I got this from the Fed website. So, SPY was 302.63, and on that day, on September 19th, the Fed interest rate was 2.04%. Okay? So now we know what the future is. As of Friday the 13th, SPY was 398.50. Well, you have 3 out of 4 variables. You can set up a ratio. You can say, oh, okay, well, if it was 302.63 back on September 19th, at that interest rate, and we know what today's level is, what interest rate would they probably be at to price it into today's number? Okay, so you set it up, isolate X, typical algebra, right? Solve for X, right? You guys know how to do that. So I'm just clicking on that so you can see the formula, that I'm not just like typing in some numbers. Okay, there's the formula, right? To solve for X. Now, 2.69 is what I believe that the market is operating on. They think, you guys have seen this in the news, and I'm not giving you commentary whether I agree or disagree with what I'm hearing in the news. You've heard the news. The market's trying to call the Fed's bluff. And I'm not telling you whether I agree or disagree with it. I'm just telling you what I hear in the news, okay? The market is calling their bluff. They're like, you're not going to stay at 5%. So I believe the markets currently are pricing in 2.69% terminal rate. That's what I think it is today. That's what I think the markets are following today, 269. Okay? That's what I think they are. Now, following with 269. 269 is 31.68% over 204. Okay? Easy math there, right? Easy math. Now, so what I did was, remember the average return over 10.5 years was 15.426%, right? Remember that? Okay. So then I said, okay, well, if the interest rate is 31.68% over the interest rate in September of 2019, then I'm going to knock off 31.68% off of that average 10-year return. Okay? When you knock off 31.68% off of this number, 15%, you're left with 10.5392. So I think that the market is currently pricing in a 2.69% terminal rate and a future return of 10.5392. Okay? I think that's where they're at. That brings you to a SPY target 421.23. Okay? That's where you're at. That's what I think the markets are trending to. Excuse me. Right now. That's your SPY target. That's where I think it's going. Now, I'm going to show you something now that's going to blow your mind. Are you ready? Maximize screen. On August 19th, 2022, SPY left a gap. 421.22 was the low. The high that it ever got back was 419.96. 421.22. I calculated based on this hypothetical scenario. 421.23. I was a penny off. Think about that for a second. I'm just going off of hypothetical scenarios. See that? I think that the markets are currently at 269. That's what they're currently pricing to today. And I came up with a target of all of these calculations. 421.23. Not knowing. I didn't even look at it yet. That the gap is at 421.22. There, see? See, this is just good old-fashioned math to estimate. Right? It's not my opinion. It's not my feelings. Who cares about that? I want to know what the math says. I want to know what I can quantify. Okay? Now, 10.5392 right here. Expected future return. That is actually low compared to years prior. Look at that right here. 26, 16, 28. Okay, there's a negative 6. 19. There's a 954. But so 10% to me, and this is what I did in the previous session. At a 5%, I knocked off just 5% flat off of this number. Take it to 10.46 instead of 15.46 right there. See that? That's a moderate recession. The markets are already pricing in a moderate recession. They're pricing it in. See what I mean? So, yes, all this stuff at the end of the day, it's just math, guys. It's math. The market algorithms, they're following programs, they're following logic, they're following conventions, they're following math. Finance 101. That's all they're doing. Here's a screenshot. How I came up with this number using the compound interest calculator. 30263, right? That was the number as of September 19th. Assuming an annual rate of 10.5392 over a period of 3.3 years, which brings us to Friday, January 13th, a couple days ago. There's your number. And you can also go the reverse. If you say, well, I expect SPY in the future, 421.23, this is the future value, and then I'm going to give it 3.3 years at 10.5392. What's the present value I should pay for it? 30263. See, so it goes in the reverse too. Okay, so there you have it, guys. The number that I just projected, it was more like an estimate, right? It's just an estimate. was off by a penny by that gap it left on August 19th. Okay? So there you have it. Basically what I'm saying is just really, it boils down to this. SPY is trading at a level today that is within the pre-pandemic expected range when you assume a 10.5% return that is compounded annually over the next 3.3 years. That brings us to Friday the 13th, today's date. That's it. We are in the expected range. The markets have already priced in the recession, and they are operating under the assumption the terminal rate is about 2.69%. So yes, they are trying to call the market's bluff. And I'm not giving you my opinion whether I agree or disagree with it. So there you have it. That's math. Okay? So, now, let's have a short discussion. Yes, indeed. If the Fed was forced to choose between inflation or the millionaires and billionaires, who would they choose? Look at the very top. I have some definitions up there. I don't think anybody's going to disagree with this. The billionaires own Congress, and Congress created the Federal Reserve. Take your pick whether when 2 times 5 equals 10. Take your pick whether Congress is 2 and the Federal Reserve is 5, or if the Federal Reserve is 5 and Congress is 2. But at the end of the day, it doesn't matter because the answer is 10. And that's the billionaires. You can't disagree with me on this. And I'll show you more reasons why. Because at the end of the day, guys, it's about money. This is about money. Not about whether the Fed is on the little guy's side. You're going to fight the Fed. You're not going to fight the Fed. No. This is about big money exchanging hands. So, the top 25% consists of almost 3/4 of all adjusted gross income. So therefore, the top 25% consists of almost 3/4 of all revenue of the IRS in the United States. That's how you should interpret that. Okay? Now, does it make sense for the Fed in the long run? I'm talking about over a year. Like, let's just say for all of 2023, 2024. Does it make sense for them to intentionally destroy the markets in the name of fighting inflation for the bottom 25%? I'm sorry, the bottom 75%, because the top 25% consists of almost 3/4 of all of the IRS's revenue. The bottom 25% is what I meant by they consist of only 25% of the adjusted gross revenue. 75% of the population consists of only about 30% of the adjusted gross income. In that scenario, who are you going to pick? Inflation for the 75%? Of course. Because the other 25% consists of almost 70% of my total IRS income. I'm not going to destroy the economy for a population that only consists of 30% of my gross revenue for the IRS. I'm not going to destroy it. I'm not going to crash the markets in the name of the little guy when they only consist of, at most, 30% of my adjusted gross income revenue to the IRS. They're not going to take your side, guys. I wouldn't. This is big, big money. How else is the Federal Reserve, they control the monetary side, going to keep up with the freaking fiscal side of Congress, who keeps racking up the national debt? They need the income to keep coming in, not going down. They need the revenue to keep coming in. You see what I mean? Too much national debt from the fiscal side. How else am I going to pay for it? You know they will live with inflation before they crash the economy, before they crash the markets to the point where there's no return. There's no way they're going to take your side on this, okay? So don't have any illusions. At the end of the day, I'm showing you numbers that are undisputed. There's no way they're going to crash everything in the name of inflation. But they have to say it publicly, of course. That's what being a politician is all about. Saying one thing and doing another. Don't take my word for it. Legalize bribery, guys. The Supreme Court already gave the green light. Right down here. Open the door for anybody. Individuals, corporations, huge, big money, dark money, interest groups, unlimited contributions to groups that have, spending on federal elections. Come on, man. It's quid pro quo. You scratch my back, I'll scratch yours. Okay? If I give you a whole boatload of money, I'm expecting something in return. So, that's just the way it goes, guys. This is the world we live in. I'm sorry. But they will choose inflation over crashing the economy and crashing corporations. Trust me. Okay? Now, let's move on to some other stuff. RSI speak. So, this was a few days ago, last week. So I talk about the RSI. This is actually CPI. Notice the RSI, except for at the when CPI first came out, boom, right? It went below the 30 line. But after that, it never did. Okay? When it doesn't go below that red line, it's not going lower. All right? That's all I wanted to show you. So, I tweeted that. Twice it found support at the same channel trend line. Right. Here's the, oh yeah, right here. Channel trend line. Found support there. And RSI did not go below the 30 line. See, RSI now coming up. Oh, I threw this little thing in there, head fakes. Because you know how on past episodes I say RSI is critical in determining a head fake, right? So I wanted to just throw that in there. Okay. Let's go back to 2002. Let's only look at RSI. Well, we'll look at the MACD a little bit. Now, this is SPY. Last time I realized actually I put in SPY futures, but this time it's SPY. So the MACD looks a little bit different. The main thing on SPY's MACD back in 2000 all the way to 2003 was it pretty much stayed below the MACD line. Okay? Even though it looked like it was making a higher low, and it was coming up here, it never got past the zero line. And as you guys know, yeah, you're going lower if you can't even get past the zero line. That's it. No ifs, ands, or buts about it. Okay? But notably, let's look at the the RSI. Let me see if I zoom in on what that looks like. Oh, well, yeah, well. Okay. Notice how consistently it kept falling below that red line. Below. right? It it didn't matter if there was a higher low. You kept going below the red line, and that's confirmed by the MACD. It's like I can't quite get back to the zero line. This is the weekly, by the way, okay, not the daily. Lower lows, lower lows, lower lows, below the zero line. That's like see what I mean? You keep going below that the red 20 line, and in the previous slide that I showed you when I talked about CPI that day, yeah, see, it didn't go below the line. You're not going lower, right? So that I look at RSI for head fakes, and I look at RSI for, are you even going to go even lower than where you are, right? That's a key determinant. And if you look at all this, yep, RSI kept going lower, lower, until this key moment happened right here. Higher. It stopped. It stopped going below the 20 line. It stopped. And it didn't look back since. Okay? You're going to see what 2022 looks like in a couple slides. Higher, stopped, didn't look back. Didn't look back for a year and a half. Okay? This is key. This is key. Higher, low, stopped at the 20 line. Kaboom. Here we go. Coincides with the higher, low. Higher, the phrase that I gave the other day. Higher, low, here we go. Higher, low, up we go. Okay? Now, lower low, lower low, lower low, lower low, lower low, higher low. Right? Higher low. And then the MACD and RSI started. This was key. This is pivotal. It changed and it didn't look back for a year and a half. Okay? MACD flattened out here, locks in the notch. This is the notch. You locked it in. When you flatten out, you lock it. That's like, because if you don't flatten out, you could still keep going down. But when you flatten out, you locked it in. Okay? Notice the trend change comes after the higher low. Notice this trend change. It's right here. There you go. Back test against the EMA. This is the weekly, by the way. Which, by the way, I think this week and next coming week could look something similar to this. It could try to just come up, but as I'm going to say, the key is the back test. The back test, not the fact that you pierced it, not the fact that you pierced it once, twice, 3 times. It's when you back test against it. See, even this one wicked below it. See, that's what I'm talking about. So don't get your hopes up. This coming week, see, we broke through the weekly EMA. Back in 2002, it broke through 3 times, 3 weeks in a row. It broke through, but then on the back test, it went back down below it. See, there's the wick. It went down below it, but fortunately, it closed the candle body above the EMA 50, and you're good. That is the moment the .com crash ended. In my book, in my opinion, in my definition. This is the moment. This is the moment the .com crash ended. Not when it made a higher low, not when it made all these nice big moves up. It's when you backtested the EMA, the jig is up. The bear market is over. Okay? From a technical standpoint, all right? Okay. So, that is basically all I wanted to show you about that. This is the key moment, guys. The RSI is not less than 20. Nice. Goodbye. Okay? But look at all these other ones. Oh, not good, not good, not good. And as you saw on the previous slide, yeah, if I saw that on the CPI day, go below that 30 line, oh, you guys, we're going lower. We're going lower. Okay? 2008. Let's check it out. Same deal. Lower lows, lower lows, lower lows. Higher low. Look at the RSI. Just couldn't stay above that 20 line. Just couldn't do it. 08, 08, all the way to 09. But once again, here's your key moment. Okay? Now, you could say, well, what about this point? That looked like a key moment. Yeah, but what was the MACD doing? No, that's not a key moment. See what I mean? When you look at them both together, like, no, that's not a key moment. But this is. And look where look where the MACD is. Oh yeah. And consequently, confirmed. Look at that. 1, 2, 3, 4, 5. It's like, wow. Yeah, but also, guys, keep in mind, this is QE, man. This is the birth of QE, of course. But as you see here, the back test very shallow. That definitely confirms it. Okay. No trend change to the left. Trend change to the right. Key moment. Higher low. Boop. Prior to that, all lower lows. Let's go to today. Lower low, lower low, lower low, lower low, lower low. Higher low. On all of these situations, the backtest failed, backtest failed, backtest failed. Obviously, we know that in hindsight. We're about to do it again. We're about to test. We're about to, you know, we're about to have a go. Okay? Now, let's look down here. MACD flattens out. Uh-oh. Flattened out. And not only that, curling up, causing separation with the signal line. The previous slide you saw, it just kind of flattened out and actually just sandwiched with the signal line. This has more power. Okay? And look at these key moments. Here, let me zoom out. Guess what? This is the hive. There's your key moment with the hive. Actually, you have two key moments above the 20 line, making higher lows above the 20 line, and now you're coming up here. You have two key moments that you didn't have in 2000 and 2008. So the RSI and the MACD are telling different stories than what has happened previously over here. Aha. RSI has bottomed. MACD has bottomed. The key, though, is going to be for the next week or two. I'm not going to say or two. The next 2 weeks, I want to see that back test. Okay? I'm not making any predictions right here. As you see, failed, failed, failed. Oh, we're going to try again. But it's not the fact that we break through it. It's how do we back test it. That's what I want to see. I want to see the down week. I want to see the red candle week. It can't be all green forever. That's what I want to see. The red candle back test week will be the key. That's going to be the key. I'm not making any predictions. That's consistent with what I've generally done. I don't make predictions. I just tell you what to look for. I don't tell you what I think it's going to do. Okay? See that? Oh yeah, we're coming up on it. We're coming up on it. Major resistance and former channels. Oh yeah. It's going to be on. We're going to find out. But like I said in previous videos, even like in December, you know, this doesn't look bearish to me. Okay? And I'm telling you, if that weekly crosses over that zero line, oh, hoo, 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 hoo. then what are you going to say? Mm-mm. So, the daily's already crossed over. Now let's see if the weekly's going to do it. Okay? So, there you have that. Now, you guys know that this is the first thing that I have on every one of my episodes. I just want to say that smart money, they aren't laughing with you guys. They're laughing at all of us. All of us. You think you know what smart money's doing? Do you really? It was their money that constructed this whole matrix. That's not an opinion, that's a fact. Okay? I want you to be careful with what conclusions you draw. That's not based off of math or sound reasoning. Be careful what your assumptions are when you make decisions as to whether you think the market's going to go up or down. Especially be careful about your assumptions that you think the Fed is on your side, when ultimately they care about income and revenue. It's going to pay for the fiscal side of that irresponsibility on Capitol Hill. All right? I can tell you that Deus Ex Machina is banking on you to draw flawed conclusions that are based on flawed assumptions. Earlier in the episode, you saw all the characters that are involved in the Matrix. This is who you don't want to be. Cypher. He knows that stake's not real in the Matrix, but to him, ignorance is bliss. Please follow me on Twitter, where I give real-time tweets intraday. Don't forget to listen to your favorite music while you're trading, because it helps get you in the mental state of mind. I know it helps me. Please give this video a like, share, subscribe, or click to be notified when I release something new. And with that, I'm Agent 000, signing off.